we're live on Facebook. Hi, you guys are live. Awesome. Nice to see you guys. Happy Thursday. I'm Vanessa Noble. I'm a realtor in Anchorage, Alaska, and I'm very passionate about teaching people how to build wealth through real estate and really learning the just the ins and outs of stacking real estate and how to really make real estate work for our clients, not just buying a home, but really looking at every purchase as an investment. And Patrick, realtor in San Diego with Compass Realty, and has got an amazing team, has built a crazy business super fast, all on the basis of teaching investments as well, and taking all of his formal education of a master's in real estate, an MBA in business with an emphasis in finance. So all of that formal education, translating it to the real estate market. So I'm really excited. And today, Patrick proposed a topic, the 15-year versus 30-year mortgage. And I'm actually really excited to talk about this because occasionally I'll get some people that will ask if they should do a 15 to 30-year mortgage. So I always love talking with Patrick on the different perspectives. So yeah. What do you got, Patrick? Let me see.
Yeah. Thanks, Vanessa. And there's a lot of misconceptions out there about a 15 versus a 30-year mortgage. We're told, and consumers are told, that a 15-year mortgage is safer, it's better because you pay it off faster, and if you can get it, you should. But the exact opposite is true, just like a lot of things we're told in life. A 15-year mortgage is actually much riskier than a 30-year mortgage in multiple ways, and I'm going to go over each of those ways today. I remember as a young child, and even now as an adult, my mom is always telling me to pay off my debt as quickly as possible, especially my mortgage. And I have tried endlessly to convince my mom that having that mortgage debt is actually a safer financial thing to do than not having it. But I don't think my mom's gonna ever change. So every birthday she sends me $100 bill to pay off my mortgage. And I put it towards it because I love my mom. I do what she wants me to. But other than that, I pay my mortgage off as slow as possible. Yes. Absolutely.
And I had a thought the other day, and I'm really curious to run this by you because I, like you, have always told people, and educated my clients, 15-year mortgages are never going to give you the most leverage. They're always going to give you a doubled liability that is, that you can't use your capital on. And then I run into a situation, and I would love to, and this was just a thought, so I would love to kind of, turn the topic a couple of ways to see what your thoughts are. But in the situation where, and just so you know my question, and as you segue and teach, we can come back to it. But in a situation where, like, when I teach people cash flow, right? I teach people that are in lower income positions to focus on increasing their cash flow through passive income, right? And then the flip switch is you teach people how to shelter their cash flow or their capital by the appreciation strategy and the negative equity, type of, or the what did we talk
negative
about?
Cash flow.
Yeah,
Yep.
Negative cash flow, right? So one thing that I had is if someone has a cash flowing building, right, where the cap rate, where it's just high cash flow, but they don't want more cash, and the rents are just high and the property was low, could they then go into a 15-year mortgage because they don't want to keep their cash flow? And so I was like, I was curious about that because I normally teach against 15 years. So I'm glad we're on this topic, and we can maybe visit that scenario. I'd love to hear your thoughts.
That's a good question. And let's address that one right now. So you've got someone who doesn't want cash flow because they want to shelter their money. They want to write off losses. So they want a 15-year mortgage because that's going to lower your cash flow. However, as much as it lowers your cash flow, it does not lower your cash flow at all in the eyes of the IRS. In fact, a 15-year mortgage will increase your cash flow in the eyes of the IRS, because when the IRS and the tax man looks at your cash flow on a piece of real estate, you can write off your interest payment, right, as a loss, but you can't write off your principal payment. So I might own a property that is cash flow break even. I don't lose money. I don't make money. It's cash flow break even. Got a mortgage on it. The IRS is still going to see it as a positive cash flow because your principal payment is considered cash flow. So if I've got a mortgage that is $2,000 a month interest and $1,000 a month principal, and I'm breaking even, the IRS is going to see that as a $1,000 a month cash flow because the principal payments, that cash flow. The 15-year mortgage is going to have a lower interest payment than a 30-year mortgage because it has a lower interest rate, but the 15-year mortgage has a higher principal payment than a 30-year mortgage. That's how you pay it off faster. You're paying your principal off
No, you're
faster.
just putting more into your equity.
Yeah,
right,
yeah, and that principal is considered cash flow, even though it's not cash flowing into your bank account. It's cash flowing from your bank account into your equity principal, but the IRS is going to consider that as cash flow.
So when I do my K1, for example, like, and let's say when I'm reporting, I will just use one of my fourplexes, for example, just because, and I was just there at the last one this weekend, because I keep one unit vacant in that building for me to go and occupy. But if I were to rent that, right? If I were to rent that, I would cash flow about $2,500 a month on that property. And if I didn't want to show that income, I mean, what am I going to do? Reduce rents, right? So if I didn't want to cash flow on that property because I don't want the income hit, right? If I were to report my gross rents versus, the losses and the gains and losses, how do you correct a building like that? If it, because I was like, well, if I wrap this into a 15-year mortgage because my rents are so high,
yeah,
instead of taking the cash flow, could I then put it into just, the principal?
Yeah,
this building is kind of an anomaly.
Yeah, if you get rents, the portion of your rents that go towards interest, that's a write-off. The portion of your rents that goes towards principal buy down on the mortgage, that's not a write-off. That's cash flow.
That's income.
Yeah, that's income. Yeah, even though it's going to principal buy down, that's income. It's getting taxed. One of the
I see what you're saying.
Yeah. Because they're saying, hey, you made that money. You put it towards your principal through your mortgage payment, but you made that money and it went to buy down your principal instead of in your bank account. In that situation, if you really want to limit your cash flow, your best option would be do a 1031 and just sell it and 1031 into something bigger. And before we get into the slide deck on 15 to 30 units, as you mentioned, like a lot of investors invest for capital appreciation rather than cash flow. As I've matured more and more in this business, my clients are becoming more and more high net worth individuals. Just this last week, I had meetings with two multimillionaires many times over. I knew them through UCLA. They were both business school grads. They're both business owners. One of them works in finance now. The other one is a CEO of multiple startups. And during my meetings with each of them, they both said the same thing. And they said, Patrick, I do not want cash flow. I want capital appreciation, but don't put me in something cash flow. In fact, if you can find me something that'll negative cash flow, but will have capital appreciation. Because again, one of these guys works in finance up in LA. The other is a woman that is a CEO of multiple startups. They have enough cash flow through their jobs and they understand finance enough to the degree that at their young age, or both in their 30s, they don't want cash flow coming off of investments right now. They want that when they're old and retired, but at this age, they just want a negative cash flow, but higher capital appreciation to write off their ordinary income losses.
Got it.
But yeah, so with the 15 versus 30, why don't we dive into the slide deck for today? And that's going to be your risk on the 15-year versus that 30-year. I'll share my screen if that's okay. All right, can you see it, Vanessa?
Yes.
So this is a presentation that I actually built while I was in business school, and we had to learn presentation skills when I was in business school. And one of my classes was just a presentation class. and I combined it with the finance course I was taking and underwriting risk that the consumer takes when taking out a mortgage. So we're going to go over that today with the 15 versus 30. My goal today is to convince you through numbers, data, and circumstances that taking a 15-year mortgage is far riskier than 30-year mortgages. When it comes to the 15 versus 30, a 30-year mortgage is going to increase your financial stability. And what you're going to see some examples if worst case scenarios happen in your life, and bad things do happen, you will be much more at risk with a 15-year mortgage versus a 30-year mortgage. So I'm going to show you that risk and how your financial stability is better off with a 30. Also, we're going to close it out the second half of today by showing you how you can increase your net worth by getting a 30-year mortgage. Because whenever you spend money on something, you're not spending money on something else. So we call that opportunity risk. If I go spend money on a $5 Starbucks, what could I have spent that $5 on? That maybe would have made me money, maybe not, but that's my opportunity risk. If I get a 15-year mortgage rather than a 30, so my mortgage payment is $1,000 more every month for 15 years because it's a 15-year mortgage, so it's a higher mortgage payment. What could I have spent that $1,000 on every single month that maybe would have made me money? We're going to go through how a 30-year can actually increase your net worth. A lot of times you'll say, hey, a 15-year, pay it off sooner. You pay hundreds of thousands of dollars less in interest payments, and you typically do, but you often miss out on hundreds of thousands of dollars, if not millions of dollars in opportunity cost. So, as I mentioned, what we're told is save money, limit your debt, get that 15-year loan, pay off your mortgage early. I mentioned at the beginning of today that my mom gives me the same advice. And the reason she does is because my mom grew up in the 70s, the 80s, and the 90s. That's when she was in her, 20s, 30s, 40s. And that's when she was buying real estate. Most folks that kind of grew up in that time frame, the 70s, 80s, and 90s, will tell you to limit your debt and pay off mortgages early because that was a smart thing to do during the 70s, 80s.
And remember, we talked about the Depression era thinking. It's the Depression era thinking.
Well,
their parents raised them, who went through the Great Depression, who gave them all these fears and perspectives on money that they felt like, paying off your mortgage and being in the rocking chair on your porch is the American dream.
Yeah, and that's also savings and loans era crisis thinking in the 1980s when interest rates were well above 10%. Interest rates on mortgage, I think, spiked out at 17%.
Yeah, I thought I saw 19, but yeah, it could be right around there.
Could have been 19, yeah. And if your interest rate is that high, Vanessa, then yeah, pay your mortgage off fast. If you've got an interest rate above 7%, above 10%, pay it off fast. But in today's low interest rate environment, it is extremely wise to, one, take on as much debt as you can and still manage, and pay that debt off as slow as possible. Because the truth is, taking out that 15 years I mentioned is going to increase your risk, and you're going to miss out on huge opportunity costs. So let's start out by talking about risk. And this is all going to be finance, like 400 level finance stuff. 15-year mortgage, what is happening is the lender is shifting risk to the consumer. When I'm like on my phone and I see these mortgage lenders pop up with ads, they'll say, hey, 15-year mortgage, this person's running up a hill fast. 30-year mortgage, this person's running up the hill slow. And they're trying to deceive you through marketing into thinking a 15-year is more advantageous. But all that the lender is doing is they are shifting risk from them, the bank, and they're putting risk onto you, the consumer. In the world of finance, there's a lot of different types of risk that exist. One of them is liquidity risk. I talk about that quite often, especially with real estate. Real estate's a rather illiquid asset, especially in markets that don't have a lot of buyers. In some markets, it's more liquid, some less. Interest rate risk is another type of risk in the world of finance. So what is interest rate risk? We sum it up here with the example of a bond. Well, first of all, what is a bond? What is a bond? You can buy municipal bonds, you can buy city bonds, state bonds, you can buy federal bonds. Those are called 10-year treasuries. You can buy commercial bonds. You can buy bonds from a company like Walmart sells bonds. All that a bond is a debt instrument saying that you are lending the government money or you are lending a company money. That is a bond. When you have a stock, you're not lending that company money. When you have a stock, you're giving the company money and now you have ownership in the company. So if I buy stock in Walmart, I now own a very small portion, but a portion nonetheless of Walmart. Pay me dividends. If they do really bad, the value of my stock's going to go down. If they go bankrupt, I lose everything because I'm a part owner of it. A bond is different. When I buy a Walmart bond, I actually don't own any of Walmart. Even though I have Walmart bonds, I don't own it. I just lent them money. I'm like a bank. I lent them money. And Walmart has to pay that bond back at a fixed interest rate. Usually bonds pay less than stocks. So why would you invest in a bond rather than a stock if it pays less? Because it's thought to be safer, because if that company does file bankruptcy, anyone who has equity in the property, i.e. stock, they just lose it all. Anyone who has bonds, they get paid out first before any leftover money might pay out the stockholders. So why did I give you that analogy on bonds? Because mortgages are very, very similar to bonds. In fact, you could almost classify them as a bond. Mortgages, your house, the mortgage you got with your lender, it gets packaged up into a lot of other mortgages and sold on the secondary market as bonds, as mortgage-backed securities in the fixed income market.
Interesting.
So what happens, how do these bonds work in the secondary market? Why am I telling you the lender is shifting risk from them to you when you do a 15?
Which is why you have to have a better credit score when you qualify for a 15-year mortgage.
Yeah, because you're taking a more risky thing on when you get a 15. It's a more risky debt instrument for you, and it's less risky for the lender. So when we are in really low interest environments, which we would all agree we are in today, okay, bonds are very risky to invest in. Now, there's another big misconception out there, and it's important we address this, even though it's not 100% real estate, but it's tied to it. All of you investors out there, there's a huge misconception that bonds are less risky than stocks. That is not necessarily true. A lot of people might think, oh my gosh, we're in this financial crisis right now. We're in a recession. I need to put my money into bonds. That would be a pretty big mistake. Why do I say that? Let's say you go out and you buy a $100 bond. And because interest rates right now are so low, bonds pay out low interest. So you can maybe go out and buy a $100 bond and it pays you a 3% interest rate. And bonds, especially corporate bonds from companies, often pay 4, 5, 6, 7% interest rate. But because interest rates are so low today, 2020, you can go out and buy that bond, maybe get 3%. I think we would all agree that because we're in a low interest rate environment, interest rates are probably going to go up in the next 2, 3, 4, 5 years. Okay. So you go out and you buy that $100 bond, and maybe it's a 10-year bond. So it's 10 years until that $100 bond matures, and it pays you back the $100 plus the interest, which you bought today at 2% or 3% interest. Well, over the next 10 years, as interest rates go up, the face value of that bond is going to go down. What's the face value? $100. Okay, you bought that $100 bond at a 3% interest rate. As interest rates go up to 4%, the value of your bond now might only be $80. And then as interest rates go up to 5%, the value of that bond might drop down to like $60. As interest rates go up, that $100 piece of paper you own, that $100 bond, is going to go down in value. And that's what we call interest rate risk. That's why as an investor right now, I would not want to go out and buy bonds. The longer term that low interest paying bond is, the more risk I'm taking. If interest rates are going to go down, i.e. if we're in a 10% interest rate environment right now, and I think they're going to go down, then I would go out and buy as many bonds as possible. Because let's say I buy a bond at 10% interest, and then interest rates go down to 9%, that $100 bond is now worth maybe $110, $120. So you might ask, well, interest rates going up and down, why does that affect the value of your bond? Why does that affect the value of your asset? It's a very simple answer. If I have a $100 bond and it pays a 3% interest rate, and you buy it today, and you're happy because you're getting that 3% interest rate, and then 2 years from now, consumers can buy a $100 bond that pays 4%, why would anyone want to buy your bond from you that pays only 3%? If consumers can go out 2 years from now and buy $100 bonds at 4%, nobody's going to give you $100 for your bond that you're holding on to that pays only 3% return. In order for your bond to be sold, people will only give you like $90, $85. They're going to discount the value of your bond because it only pays 3%. So with that little education around bonds, and guys, if I hope you understand it, but don't worry, like in grad school, I took a semester-long course on bonds. There's a lot you can learn about them, but that's the short and skinny on it. And you can see from this very simple illustration in front of you, as interest rates go up, bond prices go down. The value of your bond goes down, you lose money. So now that you have that education on bonds, pretend you're the bank. Imagine you're the bank, and you've got all these home buyers out there that want to lock in an interest rate today. And you can get interest rates today at like 2.75%, 2.5, some at 3, owner-occupied loans. Do you really want to give someone hundreds of thousands of dollars in a loan at 2.75%, and you give them a $500,000 loan, and as rates go up over the coming years, the value of that mortgage that the bank is holding on to is going to go down and down and down? Okay. So on the secondary markets where your mortgages are bought and sold, as long as interest rates go up, the value of the investment value of the debt held by the bank is going to go down. So banks.
Really quick, Patrick, and I always love to address, and then this is the problem. People always will come and bring up Dave Ramsey, which has some pretty good debt, strategies and principles, but he is not an investment educator by any way, shape, or form, of the imagination. And so Dave Ramsey suggests that you start off with the 30-year and switch to the 15-year as quick as possible. It's just not true. It's just he's really good for people that have a fixed income and live above their means and need to get out of debt. That's like finance 101. But anything beyond that, Dave Ramsey's advice, unfortunately, is just not sophisticated, or it can't be compounded.
Yeah, Dave Ramsey. Here's Dave Ramsey. No. That's all I can say about that. I like the guy. I think he has good intentions. I don't personally know him, but I do know that a lot of his advice is pretty good. Some of his advice is really bad. But more of it is good than bad. So if you want to listen to him, that's totally fine.
But the advanced stuff, the strategy stuff, like there's never been anything that I have read that I'm usually like, that's really wrong. Yeah, that's
He's really
right.
wrong.
Everything that I've read is like, no, that's not on a basis of investment perspectives at all. I mean, I think he can really help the masses because the majority of people have, restrictive incomes and are trying to improve their lifestyle. So he helps people keep a good perspective.
Yeah, so here's Dave Ramsey. I'm almost 40. I've never filed bankruptcy, and I've been able to be pretty financially successful. Dave Ramsey, by the time he was my age, had already filed bankruptcy. Okay, so taking advice from Dave Ramsey, and I hope this doesn't offend him too much, is a lot of times you might go to like an Alcoholics Anonymous class, and the guest speaker today is a prior alcoholic. And he's like, hey, this is what I did. This is how I became an alcoholic. I was asleep in a gutter. Don't end up in my position. That's Dave Ramsey. Dave Ramsey filed for bankruptcy at a very early age, I think maybe in his 20s. And he filed for bankruptcy because he made a lot of bad, risky decisions, including in real estate. And he ended up bankrupt. And because it was real estate and taking on more debt than he should have, that made him bankrupt, he is like very, very timid and scared of debt. Okay. So he had a financial failure early in life. So he is very, very, very cautious about all kinds of things. And following his advice is definitely not going to make you that wealthy. And it can actually put you in some bad situations too. And I'll show you that slide probably right after this one, I think.
Well, and we can take everybody, there's so many philosophies when it comes to money and investing and strategies. I mean, there is so many perspectives because it's very, very complex. Even in my business, active duty passive income, I mean, there's 9 of us leaders that teach all different segments of real estate investing, right? So it's like when there's no single one of us that really encompasses the full scope of all of the options. So there's so many different perspectives, and that's why you can get on bigger pockets and you can get lost. And what I love about bringing Patrick on here, and one of the reasons why I have really had him as a pillar this year of educating, is because it doesn't. You can go on philosophy, opinions, and experience, or you can go to education and learn the root of how everything is really built, and then take that knowledge and create your own life strategy. So, because everybody's going to have a different application to these principles, every single person. So, Patrick doesn't just come on here and say 15-year versus 30, do one or the other and choose. He's like, let me teach you about bonds and what's behind the actual mortgage. So when you get to the root of the education and you learn the mechanics on the back end of how things work, then you can arm yourself with that knowledge and make the most appropriate decision.
Yeah, and I see that Susan is mentioning in the chat that Susan recommends to her clients take out a 30-year mortgage. And if you have extra money lying around that you don't have to put towards other investments or whatnot, maybe put the extra payments towards your 30. I think that's an okay idea. That's one thing I would recommend.
Yeah.
Absolutely. So as you notice in the slide before you, though, a mortgage is nothing more than a bond type of asset. And that interest rate risk is being passed on to the consumer because you're not locking in that low rate. And the bank doesn't want to lock in a low rate with you for a long period of time. They want to lock in a low rate with you for as short a period of time as possible. Most people can't do less than a 15. If you did like a 5 or a 10-year mortgage, your payments would be exceptionally high. So that's why banks came out with this 15-year mortgage idea years ago to shift risk from them to the consumer. And Vanessa made a great point. Like, we're not in these webinars, we're not teaching 100 level type of stuff. And that's more Dave Ramsey teaches 100 level type of stuff. We're teaching more of the 400 level. And
this is for like, as you progressively accumulate wealth. And some of the things that I've taught on my segments is, starting from having nothing to creating investment opportunities. And then Patrick takes it from now that you have capital and you have money, how do you shelter it? How do you apply it? And how do you make it appropriate to your specific goals? And every one of your clients is going to have a different goal, different financials, different approach. So learning this helps you give the best advice.
Yeah. And there's 2 mindsets you can live by on this life. You can live by the everyday mindset, or you can live by the millionaire mindset. And the mindset, everyday mindset, I would say that's like the Dave Ramsey mindset. Everyday mindset will get you to be an everyday person. The multimillionaire mindset will get you to become a multimillionaire. I've just learned that by working with all kinds of different folks. And this mindset of take on debt as much as you can handle. I'll never say take on as much debt as possible. I'll say take on as much debt as you can handle for as long as possible at the lowest interest rate. In fact, last year I took out a mortgage on one of my properties, and I took out a 40-year mortgage. And the first 10 years is interest only, because most investors, I mean, why even have a principal payment? You don't get a tax write-off with it. This is the financial side of it. Now let's talk about the human side of it, okay? This is a human side of why a 15-year mortgage is riskier than a 30. We all go through tough times in life. All of us are going to face medical issues that we never experienced or thought would come down the line. I had a good friend of mine just get diagnosed with cancer not too long ago. These things happen. On the right, job loss. Job loss happens. We've seen it happen during this recession. And on the bottom left, the worst of them all, death happens as well. Hopefully you all have life insurance. But these are tragedies that happen in life. And it's not a matter if, but a matter when they happen to each of us, unfortunately. So how do these tie into your mortgage? If you have a 15-year mortgage, let's say you buy a house, and if you get a 15-year mortgage, your payment is going to be $3,500 a month. But if you had taken a 30-year mortgage, instead of $3,500 a month, it's $2,000 a month. Sure, you're going to pay more interest over 30 years, but at least you have a lower payment during the first 15 years. During all those years, you have that lower payment. Because if you end up in the hospital, if you end up with a job loss, or God forbid, you or your spouse passes away, and now you lose that secondary income, and you call your lender and you say, hey, Mr. Lender, I can't pay $3,500 a month anymore because of this tragedy that happened. My wife isn't working anymore. My husband passed on. I can't pay $3,500 anymore, but I can pay $2,000. Can we restructure this loan into a 30-year or a $2,000 a month loan? The lender, unfortunately, is going to tell you no. Why are they going to tell you no? Because now you don't qualify for that loan probably anymore, because you just lost a spouse. You just lost a means of income. And your debt to income no longer qualifies you for that loan that you took out 18 months ago. Okay? But if you had taken out in the first place a lower payment loan, that 30-year loan at $2,000 a month, perhaps you can now afford $2,000 a month. And if you want to make extra payments to it and pay it off in 15, 16, 17, 20 years, what have you, do as Susan said and just make extra payments. But at least you have the privilege and the opportunity to make a $2,000 payment instead of being locked in that higher mortgage payment if and when tragedy should strike. And beyond all the financial things, this, I think, is the most important reason to take out a 30-year instead of a 15.
It's the risk for sure. Because I mean, in 15 years, I mean, think about, you just don't ever know the cycles or phases of life that you're going to run into. And, you know, it's kind of interesting because if you look at the difference in savings, you know, from your mortgage payment, and you were to take that dollar value and invest it, you know, into a different vehicle, that $1,500 a month, and put that towards a different type of investment. I mean, there are plenty of things where you can recuperate that difference.
Absolutely. Yeah. If I came to you and I said, look, you might have a tragedy in the next 15 years and you or your spouse might lose your job. Do you want to lock yourself into a $3,500 a month payment? Or do you want to lock yourself into a $2,000 a month payment? It's going to take you more years to pay it off, twice as long. But if you want to, you can pay off that 30-year early and have it paid off in 17 years and have a lot less risk. When you look at it that way, I think most people would agree a 30-year is a lot less risky than the 15. And this has nothing to do with finance and liquidity risk or interest rate risk. This is just life. So this is why, Vanessa, I often advise clients getting that 30-year. Mm-hmm. But you brought up a really good point. You brought up, Vanessa, like, hey, those extra payments, instead of paying your mortgage off early, maybe you could you could invest in something, right? So the last half of this is going to be numbers. I can't do a presentation without an Excel spreadsheet. So let's look at person A and person B. One person takes out a 15-year loan. The other person takes out a 30-year loan. Usually as a consumer, this is the only slide you see. You take out a $500,000 loan at 4.1% versus a 30-year loan at 5%. And a lot of you might be thinking, my God, Patrick, why 5%? Interest rates are 3% right now. I know, I get it. I built this presentation when I was in graduate school, 2015, and interest rates were at 5%. The lower we go in interest rates, the more and more it makes sense to do the 30-year. So if it makes sense in my model that I'm going to show you over the next 20 minutes, it definitely makes sense today. Once you get around 6%, then it starts to make sense, maybe not get a 30-year, but 6% below, I built this one on 5%, absolutely makes sense. Now this slide shows you the amount of interest you're going to pay with that loan. And you can easily see the difference. With a 30-year loan, you're going to pay almost $250,000, $222,000 more in interest on that loan. So you might
over 30 years.
Over 30 years. So a lot of people would say, oh my gosh, I should get a 15-year loan, and they stopped at this slide. But you have the last risk factor I mentioned. We already talked about interest rate risk, then we talked about life risk. Now we're going to talk about opportunity cost risk, which Vanessa mentioned. Let's say, well, let's take a look. Monthly payment. These are your monthly payments. And it's pretty similar to the example I gave. It's about a difference of a little over $1,000 on a 15 versus 30, 4.1 versus 5%. And you all know that if you get a 15-year, your interest rate is lower. That's why it's 4.1 versus 5. Your mortgage payment, though, is going to be a little over $1,000 for those first 15 years. So when I was scratching my head, I said, well, you could do two things with that extra $1,000. A, maybe you need it. Maybe you just need it to live life. B, you could put it towards an extra down payment if you don't need it and pay that principal off sooner and have this paid off in 16, 17 years. Or if you're an investor, because remember, this is real estate investment type of webinar. If you're an investor, you're probably taking that $1,000 a month, over $12,000 a year, and reinvesting it into something else. And that something else is usually going to make you more than 5% a year. So let's use that example. If I take a 15-year mortgage, it's assumed that for the first 15 years, I am not investing any of that extra income because it's going towards my mortgage payment. But for the next 15 years, i.e. years 16 through 30, I am investing all of the money that I would have been putting towards a 30-year. So person number A takes out a 15-year loan. And because their mortgage payment is $1,000 more a month, that's where that investable $1,000 is going, into their mortgage payment. But for years 16 on, they're investing that $32,000 into, say, a stock. And for the 30-year owner, the 30-year mortgage, they're taking that extra $1,000 the first 15 years and investing it. And then after that, not investing it into anything. That total invested cash for the 15-year mortgage holder is going to be $483,000. And for the 30-year mortgage holder is going to be $187,000. But this graph here puts it all into perspective. So we're going to spend a minute on this one. Let's say you took out a 30-year mortgage. So that extra $1,000 per month, you're investing into the stock market. And I built different examples, a 10% return and a 7% return. And then this last example, which I'll get into in a minute. If you took out that 30-year mortgage And the extra $1,000 that you're not paying in mortgage, you invest in the stock market for 15 years. And then at year 15, you stop investing cold turkey and you just let that investment go up. You just let it sit, but you don't put any more money into it. You don't put any more money into it. At the end of 30 years, that $1,000 that you put in every month for 15 years, and then you stop at year 16, is going to be worth $1.8 million at the end of 30 years. Now, let's say you're the other person and you took out the 15-year mortgage. So you don't put an extra $1,000 in the stock market for years 1 through 15. But at year 16, your mortgage is now paid off and you don't have to pay any mortgage. Now, unlike the person who has a 30-year mortgage, the 30-year person is still paying $3,000 a month in a mortgage payment, $36,000 a year. So for this Excel spreadsheet, what I did is years 16 through 30, the person with a 15-year mortgage who now doesn't have to make a mortgage payment, they start dumping into the a month for the next 15 years, all the way to year 30. And by dumping $3,000 in the stock market a month, $36,000 a year, over the next 15 years, that portfolio grows to 1.1 million. And as you see, what is the difference at year 30 between these two portfolios? The individual who made much smaller investments, but made them much earlier in time, is almost $700,000 wealthier than the person who made much larger investments, but made them later in time. And this is why a lot of financial experts like Warren Buffett and many others say the eighth wonder of the world is compound interest. And the best thing you have on your side in investment is time. The individual who invests $1,000 a month from years 1 through 15 and then stops cold turkey will end up far wealthier than the individual who starts investing 15 years later and starts at year 16 and invests through 30, but invests a lot more. They invest 3 times as much money, but they do it later in life. They won't end up as wealthy.
There's a couple of points, and even in this one scenario that I think sometimes people just kind of don't even think of. The average mortgage, so the average life of a mortgage is about 6 years. So during that season of 15-year cycles or even 30-year mortgages, you've gone through 3 to 4 cycles in real estate and seasons of our economy and our life where the opportunity to refinance is probably going to call you. The opportunity to lower that interest rate. If we're going to look at from 2015, when this spreadsheet was made at 5%, and now today in 2020, we're talking about getting a mortgage at 2.75%. Now you really feel dumb for getting the 15-year mortgage at 4%, 5 years ago. And we're just talking about 5 years, and here we're considering the life of a 15-year and a 30-year loan, when the statistically the average life of any loan, mortgage loan, is about 6 years. And so which coincidentally is really close to a mortgage cycle. A market cycle. Every real estate market cycle is about every 7 to 9 years. And so when you look at the up and downs and the opportunity costs that you can lose, you're really selling yourself short with not having that capital in hand to make larger investments, larger decisions, diversify your economic, your financial portfolio by just having the cash in hand, and being able to make other investment opportunities, because you're strapped to, a 4.1% mortgage when now we've seen the market fluctuate in 5 years, and so refinance is a big deal. And like Patrick has used in his own personal life, the amount of times he has cash out refied his appreciated assets in San Diego to reinvest them, is also, so you're going to disrupt these mortgages anyway, so.
Yeah, and you might be wondering about these other 2 lines. I did another hypothetical calculation at a 7% return. where they're pretty darn close to break even. And then on the bottom, I did a hypothetical situation where as you get closer to retirement, you sometimes might move your money into less risky investments, into more stable investments that have a lower rate of return. So in the bottom one, I did, well, what if the first 15 years you invest for a 10% return, the next 15 years you invest for a 6% return. Nonetheless, though, every scenario I ran, you will end up wealthier by reinvesting that money into other assets besides reinvesting it into your house. And Vanessa, I think you brought up a really good point. You said the word diversify. Folks, if you get a 15-year mortgage, you are investing in your house, okay? You're investing in that one asset, your house. You're putting your money into it. I recommend, as Vanessa said, diversify. And instead of putting all your eggs in one basket, that extra money that you could have put in your house on a 15, put it in something else, put it in stocks, put it in bonds, put it in an investment property in a different city, put it in something else other than that one asset. Susan, you bring up another question and a point here saying that you recommend to people that they borrow based on one spouse's income in case one of the spouses loses the job. I wouldn't say that's bad, but I have another recommendation for you. I live my life based on reality, but I always hedge my bets. So what do I mean by that? I often recommend people, hey, buy based on both of your incomes. You know, we get married for a lot of reasons. We get married because of love. We get married to have kids. We get married to raise a family. We get married because the buying power of two people is better than the buying power of one. So that would be equivalent to saying, hey, maybe don't have kids. Don't have 5 kids, because 5 kids would be tough to manage with one person, but with 2 people you can manage 5 kids. And then say, well, but you might die, so just have 1 kid. No, have as many kids as you want. Live the fullest life you can live. And the same thing with homes. Like you get married not to live in that little 2-bedroom apartment that you lived in as a bachelor, as a bachelorette. You get married so you can combine your income and buy that home you've always wanted to buy with 2 incomes.
Patrick, and I actually have a similar strategy that I recommend that Susan brings up, and I'll tell you the scenario for which it applies when I give people strategic advice. So so especially on VA loans, having no published debt to income ratio, and working with lenders that have super flexible, that'll max out the DTI till about 65% sometimes. The reason why I try to shift the mortgage liability onto one spouse, and it's so that they can have exponential buying power, right? So that way at first, when they're not 200% liable for that asset. So if we can afford the house they intend to buy on one person, we buy it on one person's loan, because if not, the wife standalone is responsible for $300,000 on her DTI, and the husband standalone is responsible for $300,000 on their debt to income ratio, or whatever the payment decides, is. So when I help people put it on one income, it's for the purpose that, number one, they're already buying smaller than they can afford anyway, because they're using a strategy. So they don't need to commingle their debt on that particular asset. So like a husband, if and like a lot of military spouses will often have at-home businesses or non-qualifiable income. So if we know they can afford it, but we can't qualify the wife's income, or if it's part-time income that's not able to be applied, or let's say there's bonus pay that's not able to be applied on a conventional type of real estate, we still try to put all of the debt on one person to max out their DTI. If they're buying something that is beneath their ceiling, but if we have to use 2, like I just put 2 people's income on 2 multifamilies, one on a triplex and one on a duplex just last month. And it was because one, it was the wife's full-time income that supported the veterans loan package, right? So they commingled their loan. And then the other one, it was because the husband needed the wife's income in order to buy the triplex that they got, because the ceiling was too far for his income alone. So I'll commingle them sometimes, but I usually try to expand the DTI on one person so that liability isn't on both incomes, because the plan is to stack more real estate assets.
Yeah, absolutely. Yeah, Susan, I don't think your idea is a bad idea, but here's the thing. Again, saying you only have one life to live, buy the house you want. One of the reasons people are married is to combine their income and live a fuller life. And there's 3 ways you hedge your bets. I showed you the 3 worst case scenarios. Spouse ends up in a hospital, spouse ends up unemployed, spouse ends up deceased. And there is insurance for all 3 situations. The moment you buy a house, you better have life insurance. If you own a house and you don't have life insurance, call an life insurance company today and get life insurance. And you want your life insurance to be enough so that the spouse left behind can either pay off the mortgage in full or continue their monthly payments. You also, if you lose a job, unemployment insurance. If you end up in the hospital, the other type of insurance you need to have is disability insurance. Okay. And that if a spouse gets hurt, injured, lose a job, or deceased, you're still going to get income or something from that spouse through the insurance that you intelligently set up for them, so that the spouse who's still working or is left behind is not in dire straits. And that's why I say, hey, buy the house you want. I wouldn't limit myself to my bachelor pad after getting married, unless I wanted, more money to go out and invest elsewhere. So with this 15 versus 30, the last thing I want to end on, and this is, you guys all know I love taxes. I'm a tax geek, is people never talk about the tax advantages of that 30 versus 15 and how does it play in. Here again, we've got the same loan, $500,000.
This is why I love you, by the way, Patrick. I love that you're a tax geek, because I'm like, yes, let me learn from all of your wise tax advice.
So we've got $500,000 loan, a 5% interest at 30 years, or 4.1 at 15. And you could use this at any interest rates, including today's rates of like 3 versus 2.1. The 15-year mortgage, 180 months, 360 months for the 30-year. We've already kind of gone through this, and you know that the difference in interest payments is $296. Look, the difference in payments over 15 versus 30 years is $296. And the difference in interest payments, which in this you pay $170 in interest, and this you pay $460, it's still $296, because a 15-year mortgage, your payment's lower, but your principal payment over 15 is the same as your principal payment over 30. And this, Vanessa, is what we were talking about at the beginning when you said, hey, some investors might want to take a 15 versus a 30 so they can limit their cash flow. But no, because your interest payment is going to be it's not changing your interest payment. You're going to pay $296 in interest on both of these loans, or excuse me, on principal. You're going to pay $296 on principal on both of these loans over time. The delta on interest, though, is $296. I think I said that backwards. Your principal payment is going to be the same on both of these loans. It's just extended out on your 30-year loan. Your interest payment is going to be the delta, the difference. And you're paying almost $300K more in interest on a 30-year mortgage. So a lot of people would see that and be like, dang, I don't want to pay $296,000 more over the 30-year. But you're not. You're getting a lot of tax advantages on that 30-year that you don't get with the 15, because you can write off all your interest payments when you file your tax return with the IRS. And on this one, over a 30-year period, writing off an additional $296,000 in interest payments at the 25% tax rate, and you got to do the calculation on whatever tax rate you might be in, saves you $74,000. So in reality, you're really only paying $222,000 more over that 30-year period, which, again, if you're reinvesting that money, that $1,000 a month, as we showed in this illustration up above, you're going to end up wealthier even if you didn't get that tax write-off. But with that tax write-off, we now have to assume an extra $74,000 is getting piled onto that return that you're making with the 30-year payment. We're getting towards the end of time, so I'm not going to dive any deeper into the tax advantage. But at the end of the day, I would never take out that 15-year mortgage, and I would always take out the 30-year mortgage because it's safer financially. It limits your risk. It puts a risk back on the bank instead of you, and it's just safer for tragedy, should a tragedy ever hit. Vanessa, anything you'd like to add on to this?
No, I'm glad we covered it like in detail and, you know, turning the coin over. Let's check some chatter if there's anything to address.
Yeah, I see reading from yeah, Mark's mentioning, you know, survivor's benefit. Definitely, you know, as much as we advise our clients, I always tell my clients, look, as soon as you take out a mortgage, if you don't have life insurance yet, it's a good idea to get some life insurance. Maybe not whole life, maybe just term. Maybe for as long as you're going to have kids, 20 years, enough to pay off that mortgage should anything happen. And insurance, guys, is extremely cheap relative to the benefits that it can provide you.
And you know, it's funny. Somebody mentioned about Donald Trump fell for bankruptcy a lot too. Yeah, and he doesn't ever give any financial advice either. He doesn't tell anybody what he does with this money. Let's see. How do you get a mortgage without a realtor as an intermediary? Well, you just go straight to the bank. Seller buying directly from buyer. You mean buyer buying directly from seller. And I always try to remind people, I mean, over 75% of all real estate litigation is because one person was not represented. You know, even when you look at like just having a divorce situation, if you do that unrepresented, you never know what things you're leaving on the table or what things you're missing. And so I definitely don't recommend ever going through a real estate transaction without your transaction being insured. And that's one of the reasons why your realtors pay E&O insurance. And so even if you have a realtor in a neutral position, a good realtor can do a neutral job very, very well. But yeah, you can definitely go directly to a mortgage broker if you want a mortgage. So, but the thing is if you go to a realtor is going to tell you which mortgage broker or which bank is the best. If you go to Joe Schmo real mortgage broker, he's not going to tell you what competition is going to give you a better deal. So go to a realtor. And yeah,
I see, Lori, you asked what would be the motivation to take out a 15-year mortgage. The only motivation I can think of to take out a 15-year mortgage is because you've been tricked. Okay. In this life we live in, there's people looking to take advantage of you on every block of the corner. Okay. Including in financial investments. And why, if you're the bank, why would you want to give a consumer a 15-year mortgage? Because you like the consumer? No. Because the consumer's your mom? No. Banks are going to give you 15-year mortgages because they don't want to hold on to that low interest rate debt for so long. So they are tricking you. And all the marketing that they put out there on 15-year mortgages is to trick you into thinking you're saving money and taking less risk. But you and I both know that you can take out a 30-year mortgage and you can pay it off in 15 years. You can pay it off in 16 years. The only other reason I can think of other than being tricked to take out a 15-year is if you have a lot of cash sitting around, you don't want to invest it because you don't know what you're doing with investments. And if you have so much cash laying around that if you had the higher mortgage payment, you'd be financially okay. If your spouse died or ends up with a job loss.
Which at that point, you just might as well buy the asset cash.
Yeah, then you just might as well buy it cash. Like I called my lender, who's also a large time investor, and my lender is a really smart guy. And I work with him quite often. He helps me with my transactions and many of my clients, and he invests a lot himself. And one day I called him. I'm like, hey, Chad, I'm thinking about buying X and Y property all cash. And he lectured me for like 20 minutes. He's like, why would you buy that all cash, Patrick? That's so stupid. You're not
only if you don't know what to do with your money at the moment.
Yeah. And I was thinking, well, I can't find anything else I want to buy right now. I got this cash just sitting in the bank earning like 1% in an Ally savings account. Maybe You know, and he talked me off the cliff though, and I went out and I bought it with some debt. And buying with long-term debt is the best way to do it, guys. All the big investors, the syndicators that are buying 20, 30, 40, $50 million deals, $100 million deals, they are going even more extreme, and they get interest-only loans. Interest-only loans, you know, you got to know what you're doing, obviously, if you're going to do that. But most investors will do interest only because you don't want to pay that principal. Why would you want to pay principal down? It's just shifting money from your liquid bank account into an illiquid asset, one house, and you're putting all your risk into that one house.
This is like 400 level, like, you know, knowledge. What I'll say is this is the ways of the wealthy that nobody talks about. It's just true, you know. So when people are like, how do people live that lifestyle or even create the steps to get there? I mean, it's using all the strategies, not just what we talked about today, but everything we've talked about like over the last 6 months.
Yeah. And Paul, I see you mentioned that they only began offering 15-year mortgages once people started paying them off early, because banks were like, yeah, look at these people, they're paying off mortgages early. And now we can take advantage of that and just offer the 15, take less risk. And guys, mark my word, right now in a low interest rate environment, my Facebook feed is like blowing up with ads on the 15-year mortgage in a low interest rate environment. When we get into a high interest rate environment, maybe that's 5 years from now, maybe 10 years from now, call me and let me know how many banks are advertising a 15-year mortgage. Probably very few, because when we're in a high interest rate environment, banks are going to push the 30-year because they want to lock you in at that high interest rate. Now, in a high interest rate environment, if I think rates are going to go down, then yeah, maybe a 15 makes more sense. But me, I'd probably still take a 30 because I don't want to pay down principal. I just want to make my interest payment and invest what I could put towards principal into an investment that's going to give me a higher rate of return than what the mortgage interest rate is.
Cool.
And that's that. All right, folks.
That's that. All right, guys. You guys have a great week. Thanks for joining us on our investment series. And we're probably going to take just a little itty bitty. Are we on? Yep, we're still on. A little itty bitty break in our investment stuff. Patrick has his 2-hour class that is going to be a paid class that we'll be marketing here shortly. He's working on that through the holiday. And Patrick, you'll be back on with us once a month, right? Or is it once every?
Once a month for now. Yeah. And I've just got a lot of stuff I got to cram in the next 2 months, guys. I've got to renew my real estate license, which means I got to take 40 hours of classes myself. And I've been procrastinating that. So I've got to do that in the next like 45 days here. Yeah, as far as Bill and team, guys, like I really started in this business 3 years ago. And now 2020, my team is 10 people, and we're going to close about $75 million in real estate on my team. And it's my 3rd year. So if growing a team, guys, go do it. I got an email from one of you out there saying, hey, how do you get investors that are legit and want to buy legit property and they just don't want to underbid everything? Guys, I do webinars in San Diego to just consumers, and I market through flyers, I market through meetup.com, I market through Facebook, and I do webinars, and I teach what I teach you to the public. And then after I do that, 20, 30 people on the call, 5 of them call me and say, hey, can you help me buy? And those are usually legit people, because I've never taught getting a good deal is buying under list price. Getting a good deal is just getting real estate.
Right. And I do the same thing even I host home buying classes in my community all the time. Mine are specific to veterans. So I teach VA loan strategies, and, you know, out of a class of 20 or 30, I'll get about 3 people that come back every time. So, yeah. You know, when you start to teach these principles and deliver value, people will just trust you.
Yeah. I think, Vanessa, people should take what we're teaching and they should just reteach it.
Mm-hmm. Reteach it.
And you'll get good clients.
Mm-hmm. Absolutely. All righty. Talk to you guys later.
Have a good day.
Have an amazing week.
Bye everyone.